Square stock, now called Block because they want to focus on crypto and blockchain. Awkward since blockchain is down, crypto is down so much lately. So you have our software, please follow along, but we're going to pull up Square on our software. I'm sorry, Block. So guys, look at this. The stock hit a 52-week high of $288, a low of $57. It is currently at $65 per share. That is a massive drop. And of course, everybody's going to say, oh, come on. Go look at our past videos of this company. We were saying all the way along, we just don't get this price. We just don't get it. Go look at all of our past videos, but let's go further in this one and let's run the 8-pillar process again. If you're new to the 8-pillar process, I'm Paul. If you like what you hear, we look at companies, we look at stocks as buying a piece of a company. We don't look at it as buying a ticker symbol. We want to evaluate the company, decide if we want to buy it or not. If that makes sense to you, subscribe to the channel and share this with friends. So pillar number 1, we want the 5-year PE to be under 22.5. So right here on the main page, 5-year PE ratio, 382. Guys, we wanted to be under 22.5. That's pretty bad. Does that mean avoid it immediately? Some would say yes, but again, if it could justify it, if the company was going to grow 200% a year for the next 20 years, this is a nothing price to pay. Pillar number 2, we want the 5-year return on invested capital greater than 9%. So right here on the main page, it is 3%. Another X. Okay. Now, keep in mind, fast-growing companies will spend a lot of their free cash flow growing. That could be a big reason why the 5-year return on invested capital, the way we calculate it, is low. Pillar number 3, very simply, we want revenue growth over the last 5 years. So we go through our software to the income statement. We scroll down just a smidge, 2.42 billion 5 years ago, 16.56 billion last year. Look at this big jump during COVID. Why is that? Well, Square does a lot of awesome stuff. We use Square. Square is used for the software. It is awesome. And when we went to shutdown, their business skyrocketed. So definite check there. Pillar number 4, we want net income growth. So we go down to the net income line. 5 years ago, they lost 71 million. Last year, they lost 77 million. That's an X. They lost more money. In fact, they only made money in these 2 years. Now, again, they're probably spending a lot of money on growth. So you have to understand that going forward. Pillar number 5, we want to look and see, are they diluting us as owners by issuing more shares? I want to keep reminding you guys, fast-growing companies that are very, very overpriced will issue shares like crazy to fund their growth instead of issuing debt, because they would much rather issue expensive shares to people than take on debt at a high rate of cost. All right. So we scroll down to the very bottom of the income statement. We go back to the 6th year. 366 million shares outstanding, 541 now. That is an X. They have more shares outstanding. They have diluted by 50% extra. So as an example, if there's a company that has 10 shares and you own one, you have 10% of the business. If they issue 50% more shares, not a stock split, issuing 5 more shares to make it 15, you still own 1 share, but now amongst 15 shares, you now own 6.66% of the business instead of 10%. You've been diluted and cut your ownership by 33%. That is not good. Pillar number 6 has to do with debt. So guys, debt works the same with companies as they do for you guys. The more debt you have, the more likely you are to have financial problems if things get tight. So how do we calculate if it's have debt or not? So we go back to the main page. We look at the 5-year average free cash flow, 355 million. We multiply it by 5. We get a total of 1.5, let's call it $1.8 billion. We want their long-term liabilities being under 1.8 billion. Now keep in mind, guys, last year's free cash flow was almost $1 billion. Fast-growing companies, that's the problem. They're growing so fast that the average of the last 5 years will be much lower. But for our software, 1.8 billion is where we want to look at. So we go to the balance sheet, we scroll all the way to the bottom, total long-term liabilities of 5.65 billion. Now, even on last year's free cash flow of 965 million, this is still too much. So it's just again, I don't know if this is good or bad because it's a fast-growing company. So we have to sit there and look at it from a stable standpoint. Pillars 7 and 8 have to do with exactly that, free cash flow. Free cash flow is cash from operations less your capital expenditures. All right. There are 5 things you can do with free cash flow. You can buy back shares, you can pay dividends, you can pay down debt, you can reinvest back in yourself, or you can make acquisitions. All right. You can do any combination of those 5, none of them, all of them, it doesn't matter. You can do any of those things with it. So we go to the cash flow statement in our software. This sounds like a lot of math, guys. We have a shortcut for all of this. I will share with you in just a minute. But right here is our first shortcut. We actually put the free cash flow line here. It's added into our software just for our users. Cash for operations less your capital expenditures. 5 years ago, they had 106 million in free cash flow. Last year, 965 million. Check mark there. So that's pillar number 7. Our final metric, pillar number 8, we want to treat the free cash flow similar to earnings and apply a 22.5 multiple to free cash flow the last 5 years like we did with earnings. So we look at the average of the last 5 years of 355 million, multiply it by 22.5. That's 7 billion, 7.7, and another, call it $7.8 billion. Okay, I just got a message from somebody in our chat. Not now. So $7.8 billion. We want the market cap to be under $7.8 billion. Oh, geez. Go back to the main page. Market cap of $35 $5 billion. So that's a big X. Now, here's the major shortcut for all of you people who don't like doing the math. Here's the 8 pillars tab right here. It just shows you all the X's and checks. Nice and easy for you. Look at this. 100 times free cash flow, 380 times PE. So again, this mean don't buy it? Well, no. If it were to grow 200% a year for the rest of the time, it'd be an automatic buy. So that's why we created the stock analyzer tool. Stock analyzer tool allows you to make those assumptions about the future and determine what you should pay for the stock today based on those assumptions and based on a certain desired return. So what are these assumptions? Well, let's go to analysts. These are the analysts' expectations for earnings per share for the next 10 years. A big drop from last year is expected for this year. Why? Probably less transactions. But as you can see, it's going to grow big time, 12 or 13 times in the next 10 years. What is that? I mean, that's a growth rate of 30, 40% on just earnings. Now, what about revenue? Revenue is supposed to be 17.8 billion, which is a little bit of growth from last year, and go to 58 billion. If you look at these numbers, let's call it around a 15% growth rate over the next 10 years. All right. The first line in our stock analyzer tool is asking for our revenue growth rate. So I always pick the analyst number as my very high end number. Spoiler alert, they tend to not hit those numbers. Analysts tend to be overly optimistic in the long run, especially in bull markets. But I'm still going to do that. So for the low end, I'm going to do 5, I'm going to do 6, I'm going to do 11 and 15%. Profit margin. Now guys, profit margin isn't going to be negative going forward. I imagine it more stable. The earnings per share is going to be there. So I'm going to do profit margin of, well, what's PayPal's profit margin? That's something to look at. So let's go check out PayPal's profit margin because that might be a very similar or something at least close. Profit margin on PayPal over the last 5 years is 15%. Let's do 5, 10, and 15%. Free cash flow margin, I'm going to do the exact same thing. Now, PE. Guys, PE is a factor that's dependent on moat and growth rate. But remember, we're doing 10-year analysis. At the end of 10 years, they've already grown a ton. So you have to assign a PE and price of free cash flow multiple based on the end of that time, after they've already grown a ton. So what's their potential from there? Probably lower. So I'm doing 14, 16, and 18. Now, if you really, really believe in blockchain, and if this thing is going to be the future of blockchain for whatever reason, then maybe you put a higher multiple in. This is where the art of investing comes into play. And finally, guys, desired return. Now, usually I do a 12.5% return. I'm actually going to do 15% here. Why? There's a lot more competition coming in this business. The margins are unknown, really. So we have to put a little bit more buffer in there for ourselves. So there's a lot more unknowns in here. And the more unknowns you have, the less confident you are, the higher return you should put in there. Hit the analyze button, $65 stock price. Oh, wow. Look at this. Guys, a low of 20, a high of 130, and the middle, 60. And we're at 65 currently. So I'm going to add this to my watch list at 59.67. Notify me when it goes below that. That is what's so great about this software. This software allows you to do all this research, get part of the community. You guys saw I got tagged in a couple messages. Allows you to go do all this. And 12,000 people have signed up for the software since we started it. And a lot of them are in here talking every single day about these investments. And I assure you looking at Square, Block to understand it. Instead of doing all this research, because this tells me, hey, maybe I want to pay attention here. I want to do more research to see, is this thing a real flyer? Are these middle assessments accurate? Because if they are, I might want to buy in. So do that research. Less than a cup of coffee a day. Everythingmoney.com. Check it out. If this kind of tech company interests you, check out our playlist of other tech companies we've done in the past. And don't forget to subscribe to the channel. Thanks very much.